Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everybody. In China and other parts of Asia, today is Tomb Sweeping Festival, officially a national holiday of the People's Republic of China. Traditionally, during this festival period, families would visit the tombs of their ancestors to clean the grave sites and make ritual offerings. Also today, Taiwan's Tsai Ing-wen is in California to, among other things, meet with US lawmaker Kevin McCarthy. We will discuss the visit and Beijing's response, which is already quite fiery, rhetorically at least, tomorrow. And also tomorrow we will be discussing the high-profile visits of EU leadership to China. There is a lot going on this week. For regular viewers, it may be worth checking that you have not been unsubscribed by YouTube, which has been happening again with some viewers it seems. For today's episode we have a lot of economy-focused updates. So without further ado, let's jump in. Beijing's corruption crackdown on its $60 trillion financial sector looks to be deep and only just beginning. At least 20 financial executives have already been probed or penalized since late February. Last Friday, we learned that Liu Liange, a former Communist Party chief and chairman of the Bank of China Limited, has been placed under investigation for suspected severe violations of party discipline and laws, a euphemism which typically means corruption. Liu was removed from his positions back in February without any explanation, and is the most senior banker to become implicated in the current crackdown, and the highest of any corruption probe in over 2 decades. Over the weekend, officials from the China Banking and Insurance Regulatory Commission and the Central Commission for Discipline Inspection called in top executives from at least 6 big state-owned banks, warning them that the industry crackdown, quote, is far from over, end quote. Meanwhile, on Monday, China Renaissance Holdings Limited said it has suspended trading of its shares and has delayed the release of its audited results for 2022. The investment bank says it has still not been able to get in touch with its chairman, Bao Fan, who has gone missing and is believed to have been detained for corruption investigations. More on the financial industry later in the video. Next up for the economy, the Canton Fair, China's biggest twice-yearly trade expo, will resume in person from the 15th of April, after 3 years of virtual activities. Tens of thousands of buyers from over 200 countries have registered to attend. The fair, held every spring and fall in the southern city of Guangzhou, also known as Canton in English, is widely seen as a barometer of China's foreign trade, in the words of one commentator. As such, this year will be particularly important to follow, as China's exports and imports continued to decline in the first 2 months of this year, and, as we explored last week, some manufacturers are diversifying their supply chains away from China to hedge against geopolitical risks. Next up for the economy, according to a Hong Kong Stock Exchange filing Monday night, fallen giant China Evergrande Group said that it has finalized an offshore restructuring deal with a key creditor group, an important development in its efforts for a massive debt overhaul. Quote, members of an ad hoc group of investors holding Evergrande offshore notes signed 3 restructuring support agreements. The debt restructuring for Evergrande is one of the country's largest ever and carries broad implications for its financial system. The proposal also serves as a reference point for other defaulted Chinese builders working to revamp their leverage loads. End quote. Creditors are likely not too happy with the deal, but evidently can swallow it. Quote, there's still a lot to overcome, but it seems like there could be a viable solution for this company to exist in the future. This is not a terrible deal, at least compared to the worst-case scenario that was priced in October. End quote. Most Evergrande notes have stayed under 10 cents on the dollar, even after recent revamp plans, suggesting low investor confidence. This, of course, all has implications for the wider housing sector and financial system. Global creditors are still facing a tough road to recover money from China's troubled developers, as the property crisis continues to shake up China's almost $800 billion offshore bond market for a 3rd straight year. Lengthy debt restructuring processes and litigation has frustrated bondholders' efforts to make defaulters pay, undermining confidence in the wider bond market generally. Builders defaulted on more than 140 bonds in 2022 and missed payments on a combined $50 billion worth of domestic and global debt. Quote, "We haven't seen a cluster of this many defaulted cases in China in many years. It's difficult to use past benchmarks. It's a precedent-setting moment." End quote. International creditors have also not missed what appears to be discriminatory behavior. Distressed developers have tried to meet domestic obligations, pledging them over overseas ones. For example, Evergrande has paid coupons to local holders for months since its offshore default in late 2021. Things may be improving, but this year will still be very bumpy, with things going from quite bad to perhaps just bad. In a recent report, for example, Goldman Sachs predicts the default rate for Chinese high-yield property firms will ease only to 28% in 2023 from more than 40% in 2022, but only if the sector is managed and supported competently. Okay, next up, part 2 on the economy, and we move from one potential systemic crisis to an even bigger potential systemic crisis. Hey guys, if you enjoyed today's episode of China Update, as always, don't forget to hit that like button. It's just me that makes these videos every day, and it is a lot of work, so this liking and sharing is a huge help. And for anyone who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. We return to a pet topic of my own, local government fiscal health. If anything is to bring down the Chinese economy and financial system, I believe the local debt and fiscal crisis presents that biggest risk and demands masterful management from Beijing to avoid catastrophe. Today, Chinese financial media outlet Yicai Global reports that local governments issued around 2.1 trillion yuan, $305.3 billion of bonds in the first 3 months of this year, up a sizable 15.6% from a year earlier, with most going to finance infrastructure projects, a tool used to maintain economic growth levels. What is most incredible, however, is that, based on Yicai Global calculations, refinancing bonds used to repay debt jumped 73% to 440 billion yuan, $63.9 billion in the first quarter alone, year on year. Quote, "The increase in the amount of refinancing bonds sold in the quarter reflects the relatively high pressure to repay bonds that are maturing this year." End quote. China Changxin Credit Ratings Group, in a report this month, writes that local government bonds worth 3.65 trillion yuan, over $500 billion, will fall due this year, and, quote, "around 3.2 trillion RMB of refinancing bonds will likely be issued." End quote. The fiscal challenges facing local governments is a topic we have explored thoroughly for some time on China Update, representing, in the humble opinion of yours truly, the most difficult financial sector challenge for Beijing. S&P Global Ratings analysts recently calculated that local governments' direct debt exceeded 120% of revenue in 2022, well above Beijing's own threshold for an acceptable debt level, and these are just average rates. The southern province of Yunnan's outstanding debt to fiscal revenue hit an eye-watering 1,087% last year, the highest among all provinces. Gansu was third at 970%, and Guangxi was fifth at 910%. Quote, "The country's provinces and municipalities have relied heavily on expanded bond issuance to carry them through a COVID-triggered economic slowdown and collapsed land sale revenues." End quote. A budget category called local government funds saw revenue from land sales drop by 23.3% last year, a decline of about $300 billion. Land use sales are likely around a quarter of local government's total revenue. This forced China's central government to increase its transfers to local governments by 17% in 2022, which in turn accounted for about 60% of the increase in the central government deficit during the same period, according to S&P analysts. The IMF estimates that explicit local government debt has nearly doubled over the last 5 years to over $5 trillion last year, and this doesn't even include all categories of debt. For example, the massive debt of local government financing vehicles is not included in this number. Of course, Beijing is painfully aware of this issue. Indeed, it is likely one of the key reasons why this year Beijing prioritized reducing systemic financial risk and launched both a corruption and reform campaign in the sector. Some commentators believe this has been prioritized over growth. Quote, "With a conservative growth target, this may signal a potential shift in focus to tackling financial risks and hidden debt from local governments at some point this year, particularly in H2, after the economic recovery has largely stabilized." End quote. Some commentators argue that local governments can just look for different revenue sources. But unless there is an explosion in productivity or exports, this would simply mean taking from households and reducing much-needed consumption, or from private businesses, and hurting the best driver for economic dynamism. To make this policy challenge more difficult, reform must be pursued while competing with other, sometimes contradictory, policy priorities. Quote, "Some of China's most indebted local governments are on a hiring spree, a move that analysts say could put fragile regional finances under more strain as officials seek to create jobs for a record number of graduates entering the workforce this year." End quote. On this point, let's end, like we so often do, with an observation from Peking University's Professor Michael Pettis. Quote, "Even as revenues are squeezed and they are having trouble paying existing employees, many local governments, worried about unemployment among the young and recently graduated, seem to be on a hiring spree. The local governments adding the most jobs in relative terms are also among the most indebted. If this hiring spree represents transfers from local governments, e.g. through the sale of state assets, to newly hired employees, it would at least be positive for rebalancing and would help boost local businesses. If it represents transfers from other forms of social spending, however, it won't help." End quote. So, debt is high, spending is high, youth unemployment is high, and growth is slowing. Chinese policymakers have an increasing number of balls in the air, all while its working age population shrinks. The hope is that Beijing can ease the country off a reliance on investment-driven growth, balance local government books, ease the fiscal health at these levels, all while ensuring economic growth, no longer supported by robust government spending, as well as employment, doesn't fall through the floor. It remains to be seen whether this is even possible. A poison may need to be taken. The question is, which one will Beijing pick? Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful day wherever you are, and I will see you all tomorrow.